If you're into trading, you've definitely come across this question. When it comes to moving averages, should you go with simple or exponential? One's slow and steady, the other is fast and, well, a little frantic. So which one is actually right for you? Let's get into it.
Right? You pull up your chart, you go to add a moving average, and boom, you're hit with that choice. Simple or exponential? It seems like a small detail, but believe me, the one you pick can really shape your entire trading strategy.
You know, the best way to think about this isn't about which one is better, it's really about their personalities. And it's just like that classic story of the tortoise and the hare. They're both running the exact same race on your chart, but how they run it, totally different.
Okay, first up, let's meet our speed demon, the hare of this story, the exponential moving average. Most people just call it the EMA.
So yeah, the EMA is our hare, and its entire game is built on one thing: speed. It's designed to react to the newest price changes, like right away, which can give you a real edge in markets that are moving fast.
So how does it do it? Well, the EMA's whole strategy is to focus on what's happening right now. It gives more weight, more importance to the most recent prices. That means it hugs the price action super closely, which is why it's such a popular tool for short-term trading.
And the biggest advantage of being so fast? You can spot a potential trend almost the second it starts. And you know what they say? The earlier you get in on a trend, the more of that juicy move you can potentially capture.
But, and this is a big but, there's a trade-off. Because the EMA is so sensitive, sometimes it can be a little too jumpy. You get a sudden, random price spike. Some people call it market noise. And the EMA might scream, "New trend!" when it's really nothing. It's really easy to get faked out.
All right, now let's talk about our other racer, the tortoise of the trading world, the simple moving average, or SMA. Its motto is literally slow and steady wins the race.
Just like the story, our tortoise, the SMA, couldn't care less about quick sprints. It's looking at the big picture. It does this by giving equal importance to every single price point it's looking at.
The SMA's game plan is all about one thing: clarity. By moving more slowly, it filters out all that short-term noise we were just talking about with the EMA. What you end up with is a much smoother, cleaner line on your chart, giving you a way clearer picture of the real, long-term trend. And that is the tortoise's superpower. Its slow, deliberate calculation acts like a hard shell, protecting you from reacting to every little price jump. This patience is exactly what can help you avoid getting tricked by all that market noise.
So what's the downside to being so careful? Well, by the time the slow and steady SMA finally confirms that a new trend has started, the price might have already taken off without you. You might get in, sure, but you've probably missed that picture-perfect entry price right at the beginning.
Okay, so we've met our competitors, we've got the fast hare and the steady tortoise. Now let's put them right next to each other to help you figure out which champion you want to bet on for your own trading race.
Let's just boil it all down. With the SMA, our tortoise, you get a beautiful, smooth chart that filters out most of the fakeouts. The catch? Your signals are going to be late. With the EMA, our hare, you get signals that are lightning fast, but you're way more likely to get false alarms. It's really the ultimate trade-off: speed versus safety. So here's the simplest way to think about it. If you're a short-term trader who needs fast signals and can handle little noise, the EMA is your hare. But if you're a long-term trend follower who craves clarity and hates fakeouts, the SMA is definitely your tortoise.
So that brings us back to the big question: who wins the race? Well, the answer might actually surprise you. See, the best strategy isn't about which indicator is better, it's about which one is better for you.
So what's the final verdict? Honestly, there is no single best moving average. It just doesn't exist. The right one for you comes down to your personal trading style, how long you hold your trades, and frankly, how much risk you're comfortable with. But check this out. Here's a little twist. You don't actually have to pick one. A ton of successful traders use both at the same time. They get the best of both worlds. They might use a long-term SMA, our tortoise, to see the main trend, and then use a short-term EMA, our hare, to find a perfect entry point. Look, the only way you're gonna figure this out is to get your hands dirty. Seriously. Pull up a chart, add an SMA, add an EMA, and just start playing around with the settings. Try different periods, like a short 20 period versus a long 200 period, and just see for yourself how they behave.
So in the end, the question isn't which indicator is better. The real question is, how will you use them? Are you going to be the quick hare, the steady tortoise, or are you going to be the clever strategist who builds a team with both? It's your race to run.